The latest 2015 acreage estimates also raise questions about farm program spending. Which program will growers choose? January was a terrible month for commodities. When will the market find its footing? Crude oil stocks grow, but diesel supplies tighten. What's the latest on fertilizer and fuel costs for 2015? I'll have these stories and more on this edition of The Buzz. Senior editor Bob Bergdorfer is on assignment in Brazil, where all signs point to record production. But farmers in the U.S. are also ready to plant more soybeans in 2015. Just how many remains a debate. The latest entry in the discussion came from the Congressional Budget Office. The CBO put corn acreage 89 million, 1 million more than USDA's December estimate. But those projections are made statistically. Our January survey of growers split the difference at 88.5 million. For soybeans, the CBO is at 86 million, 2 million more than USDA projected in December. Both are substantially below our recent survey, which showed another big increase in soybeans to 88.3 million acres. Market analysis isn't the main job of the CBO, of course. It forecasts acreage to gauge farm program spending. In addition to prices, the agency had to estimate which program farmers will choose for the 5-year run of the 2014 bill. Our analysis and university studies showed corn returning more on soybeans than average. The CBO forecast backs that up and also shows agriculture risk coverage paying better than price loss coverage for soybeans. But for corn, the CBO earmarked barely a quarter of its budget for ARC, with 72% going to PLC. That's contrary to what we found both in our survey of growers and a county-by-county study. The clock is ticking on these issues. Decisions on updating program yields and base acres are due February 27th, with program choices needed by March 31st. USDA updates its baseline forecasts and county yields in February, so more numbers will work into the analysis. The shortest month will also be a busy one. January, of course, was a bad month for the grain market, and other commodities from cattle to crude oil also suffered. For corn and soybeans, weakness this time of year isn't unusual. July corn futures on average make a bottom at the end of January in years of normal production, then stabilize in February before making another low in early March. The trend had been looking bullish, but this break puts that in doubt. For soybeans in normal years, the low comes before Valentine's Day. Soybeans held up fairly well until after New Year's, and the decline has been swift. Charts are looking bearish, so the acreage debate can't begin soon enough. New crop prices normally hold up better, but both November beans and December corn are at unprofitable levels. Both seem ready for surrender in the battle to buy acres, with the soybean to corn ratio in neutral too. Lower prices make cost controls even more important. News is mixed as buying decisions are finalized. The collapse in crude oil prices keeps that market depressed, but diesel costs are starting to move higher. Midwest inventories are down, with refinery shutdowns keeping production lower than normal. Stocks could rebuild a little in February, but agricultural demand should kick in soon. It looks like prices have bottomed at wholesale price points, with basis against ultra-low sulfur diesel futures starting to firm. I've recommended having all spring fuel needs covered, as well as a start on fall fuels. Propane prices could head lower once the heating season ends, but they're cheap now for buying 50% of drying fuel. Locking in fall diesel is tougher. Basis for contracts over summer is stronger, but prices are still cheap, so getting started makes sense. While there's no indication crude is bottom, supply chain disruptions can happen at any time. Fertilizer costs remain above year-ago levels thanks to those same supply chain problems. Phosphate prices are inching higher on wholesale markets due to trouble getting supplies out of North Africa. Average retail prices look fairly valued right now, with swaps market only showing a small decline into April. 525 to 550 may be about the best value right now for DAP. Retailers buying ammonia now are doing it at lower levels. The Gulf Index is off some $145 a ton from fall highs, but costs are still expensive, around $680 a ton on average at the retail level. Prices could ease a bit, maybe $20 on slowing demand, but new supplies in the U.S. won't hit the market for another year. Urea swaps are showing a $40 price drop into summer, but getting fertilizer into position for spring likely will run around $4.50 on average, though some of the new offer sheets have been about $15 below that. UAN remains pretty firm, with so many growers opting to apply nitrogen later this year, trying to save money. Potash also remains firm, though wholesale prices have pulled back a little. Without cuts to rents in 2015, making a profit is impossible at current prices. There's hope for at least some type of rally into March and April, but my targets are falling fast. Bob Bergdorf joins me next time to talk about what's happening in Brazil on the next edition of The Buzz.
We'll have to have more margin now, there isn't any doubt. So you better dash with a load of cash or we'll have to sell you out.